importante su questo 40% di PIL. La parola a Robert Mundell, che è il nostro ospite d'onore, siamo veramente lieti di averla con noi. In una recente intervista il professor Mundell ha definito l'attuale crisi diversa da quella del 29 e forse più vicina al collasso del sistema monetario internazionale degli anni 70. Ha inoltre evidenziato che oggi gli Stati coprono tra il 30 e il 60% dell'intera spesa del sistema paese e quindi dice per difendere in sostanza sanità, pensioni e posti di lavoro forse occorre anche ridurre la pressione fiscale sulle imprese. Alla luce di questi scenari chiediamo quali sono le riflessioni che possono essere fatte per i nostri investitori istituzionali e previdenziali. Egregio professore, la parola a lei.
All right. Thank you very much. It's a great pleasure for me to be here. It's always a pleasure for me to come to Rome and talk about economics. We're in the midst of one of the big crises, and maybe there are several conundrums associated with this. There's some mysteries that I think maybe everybody understands. They're all understood by somebody, but they're different ones. Nobody understands everything about the crisis. I think that it's a good lesson to have a certain amount of modesty in looking at these things. Nobody has all the answers to it. I'm going to present some answers of my own, and we'll have to see whether you think they're right or not. I'll talk about the origins of the crisis, then how that, the financial crisis, then how that the path of the economy, different economies, and the lessons from that, and something about the bailouts, and then the impact on the exchange rate system, and conclusions. It may seem strange to talk about the exchange rate system, but that's figured rather importantly in recent months. President Sarkozy in October made a speech in which he said that we have to revise the international monetary system, and he said from scratch. And that led to some positive comments from Chancellor Merkel and from Gordon Brown, and the result was the G20 meeting, summit meeting that President Bush hosted in November. And not so much came from it, but there was the expectation that they're preparing something that will be more substantive in the next round. So I'll say some things about that. But first we start with the origins of the crisis. It started in the summer of 2007, flared up in September and October of 2008, and is still with us today. It had its origins in the policies associated with the global slowdown of 2001. I say its origins. Of course, we could go much further back and find antecedents to it, but we'll start with the 2001. The interest rates were kept at unprecedented low levels for several years, leading to a lower dollar and inflationary effects in the rest of the world. Well, you have to ask why is that? Why were they kept low? And psychologists would say, would peer into the brain of Alan Greenspan, chairman of the Federal Reserve Board with great prestige, and they would realize that in the preceding crisis of 1990, he was sharply criticized for being too slow in expanding, getting interest rates down and moving forward. And thinking of his legacy, people say he wanted to make sure he wouldn't be criticized for that again. Now, he is being criticized, but for going too far in that direction. So you can't always learn. But we should know that the boom, the United States economy has had a remarkable period, 25 years of expansion, more or less up to the present time. There's been starting in the expansion started in 1982, in November 1982, and then went on until 1990. And then there was a 9 months recession or contraction, and then it went on for 10 years, the longest expansion in American history, and then there was another 9 months contraction, and then it went on for 6 years and until the current contraction. Now, of course, the National Bureau of Economic Research just said that the U.S. economy has been in recession for a year. But this is looking backwards in a different way than people is using a different definition of what people use. People have used the term recession to mean 2 consecutive quarters of negative growth. And that didn't happen until just now. We haven't even had that second quarter yet. We know the third quarter of 2008 was negative growth. We haven't had the fourth quarter yet. But probably it's going to be negative. So the recession, by the old definition, is now upon us, and it may even go on for three quarters the way the other recession did. Well, the 2 factors were involved in the boom, this expansion boom. One was low interest rates. The other was the low dollar. Low interest rates made housing attractive for domestic customers. The low dollar made them attractive for the rest of the world. Everybody wanted to get into the housing market. Every easy money, low interest rates, and the low dollar then led to rising home prices. Just let me say this, that almost every recession in the 20th century in the United States has always been associated with 2 industries, housing and automobiles. Each recession, you can clearly, from at least World War I, all the recessions have been involved both housing and automobiles. And this is why, of course, the current recession looks as if it's going to be a deep one, because they're both strongly involved in this. Now, the rising home prices. Mortgages were offered to marginal customers with small down payments. It seemed safe as long as house prices were rising. As long as house prices were worth more than outstanding mortgages, they seemed to be safe. The crisis began when housing prices peaked and began to fall. Soon the amount owed on mortgages threatened to be higher than the resale value of houses. Homeowners walked away from them when their equity became low or negative. Now, let me just ask a question. Can you do that in Italy? Can you walk away from a mortgage if you? I don't think you can. I haven't looked carefully, but you can't do it in a lot of European countries. But you can do it in the United States. You can walk away from them, and the bank is left holding the bag here. Let me see. Yeah, that's right. Now then, something else happened here. Historically, mortgages were local. The bank that issued the mortgage was the bank that held it. Then once mortgages could be insured, they could be sold on Wall Street. At first, insurance companies were glad to get these risky but highly yielding assets. The banks thought they were safe because the mortgages were insured, called credit default swaps. But now, U.S. law, unlike European law, and I think it's true for most European countries, allows owners to walk away from their mortgages, leaving the banks holding the bag. This is a special feature of U.S. mortgage law. In many, if not most other countries, any loss to the banks from the sale of foreclosed assets is a debt of the original borrower. The U.S. system coddles the homeowner in several ways. In taxes, because interests are deductible from taxable income, and in regulations and in policies. In policies, for example, the 2 big semi-public mortgage banks, Fannie Mae and Freddie Mac, were required to invest 70% of their mortgages of their investments in low income people. So weak assets here. Now, at the time, the spring IMF, in the spring of meeting a year and a half ago, the problem was discussed of these weak assets. But everyone thought the banking system was strong enough to handle it. Suddenly, Bear Stearns got caught. This is June June of 2007. Its failure in June 2007 created a massive scramble for liquidity that came to a head on Thursday and Friday, August 9th and 10th, 2007. Then with this, what was going on here is that Bear Stearns Investment Bank announced that it was intended to bail out two of its failing hedge funds by extending them something like up to $3.2 billion in emergency loans. The loans were designed to prevent the hedge funds' creditors from seizing and selling assets and to prevent the hedge funds from triggering a systemic breakdown of the world financial system. This constituted the largest known bailout since Alan Greenspan coordinated a $3.6 billion bailout of the long-term capital management hedge fund in September 1998 on the verge of a general crisis. The two Bear Stearns hedge funds had invested in exotic and very risky collateralized debt obligations, CDOs as they're called. These CDOs were predominantly invested in subprime mortgages. The two hedge funds borrowed $9 billion from banks and investment funds like Merrill Lynch, JP Morgan Chase, Citigroup, Deutsche Bank, and Lehman Brothers. The two hedge funds leveraged the $9 billion in borrowing into $29.7 billion in gambling debts on CDOs linked to the housing market. But the meltdown of the subprime mortgage crisis and the rise of interest rates caused the Bear Stearns fund's bets to go wrong. They lost billions of dollars. The problem was that the hedge funds had given the lending banks CDOs, collateralized debt obligations, as collateral. As the hedge funds' difficulties intensified on June 10th, Lehman Brothers seized and sold the collateral, the CDOs, and in the market, but received only 50 cents in every dollar. Suddenly, this was a shock. The big lender, Merrill Lynch, threatened to auction almost $1 billion of Bear Stearns CDOs it held on the market. But Merrill Lynch only sold 100 million of the higher quality CDOs. Were Merrill Lynch to have attempted to sell the remaining CDOs on the market, it would have found they were worth only 30 to 50 cents in the dollar. The problem was colossal, so the Federal Reserve intervened. Bear Stearns was then sold to JP Morgan for $2 a share. The shock gave rise to a desperate scramble for liquidity. Recognizing the liquidity crisis, the European Central Bank offered unlimited credit at 4% in the middle of August. Well, actually, it was on August 9th, 2007. And they increased liquidity in that one day of August 9th by 95 billion euros, single day. Then 6 hours later, the American market opened and the Federal Reserve added to it about $26 billion. Without this massive infusion of credit, the world financial system would have collapsed. The good news about it was that there was an elastic, flexible system that could act quickly. And just imagine, had we been in, why I've mentioned, Chairman mentioned that I said it's very unlike the gold standard period. Had there been this huge increase all of a sudden in demand for liquidity like this under the gold standard, you couldn't have got any more gold because liquidity depended on the amount of gold in existence. So it would have seized up the system. That would have been an even greater crash than took place in 1929. But now, in these days, the central banks had to inject these huge funds, and I've just repeated that, what I've said there. This is the amounts on those 2 days. Just absolutely colossal, mind-boggling amount of money created in 2 days, $250 billion over the whole period. And this doesn't count additional amounts of almost every big central bank in the world. I don't know what the figure was for Italians operating here, but I think the the Italians would have been nothing because everything in the Eurozone was done by the European Central Bank. But the Japanese and the Canadian banks and all these others were involved. Then the phrase subprime mortgage crisis suddenly reverberated around the world. I was last summer in Timbuktu, Mali, in the government of Mali. I was asked about the subprime mortgage crisis. It had just come into being. Shows how communication spread. Then the rating agencies got caught on too late. The credit default swaps, these insured mortgages, magnified the leveraging the system. The total amount of insured assets in the system was over $50 trillion. It's about 5 times the total amount of mortgages that are in the system, just to show the way that's working. Well, as this was going on, we have to keep up the credit system. Then last summer, a year ago, was in this bad shape. But then what was happening to the real economy here? And I look at the U.S. economy. The first 3 quarters of 2007, all the major economies, including emerging markets, moved strongly forward, including that period during the summer of the liquidity crisis. Lots of liquidity in all the emerging markets, fed by U.S. deficits. China's bulging international reserves with $1.8 trillion. And then Secretary of Treasury Paulson said that he's never seen the world in such splendid shape. He's never seen the world, all emerging markets moving together. I could have said the same thing, because it certainly was true that the real economy was in the best shape it's been in. In fact, the whole period from 2002 to 2007 is one of the most remarkable periods in the world economy. I don't think that there's a period that it could be compared with. But now, then growth rate in the third quarter grew nearly 5%. The U.S. economy. But then for 2 quarters, the last quarter of 2007, the first quarter of 2008, 2 quarters growth plummeted to about 0.5%, barely avoiding the definition of a recession. It was a growth recession, but with little impact on employment. And then in the second quarter of 2008, there was a growth figures of 3.3%. That looked as if the U.S. economy was moving forward rapidly. But the economy went south in the third quarter of 2008 by 0.5%. And then we'll wait for what happens in this coming quarter. But most forecasts seem to say it's likely to be negative growth in the last quarter of 2008 of 4%. So the output seems certain to fall, given the definition of the recession. Now then, it comes, get back to the financial economy. And there's one thing to be explained is why the financial economy had this big crisis, bailed out by liquidity in 2007, and then waited another 15 months or 14 months to have the Lehman crisis and the even bigger crisis that took place in September. This was a strange, there has to be a reason for that delay in it. Well, Lehman went down in September 2008, a shock that threatened many other institutions. The Lehman bankruptcy was 6 times bigger than Enron's, the previous biggest bankruptcy, 6 times bigger than Enron's. So the failure of Lehman threatened the failure of AIG, the biggest insurer in the world, because of all those assets that were involved. The collapse of Lehman Brothers, and then Bank of America takes over Merrill Lynch. Failure of Washington Bank, a very big bank on the west coast of the United States. J.P. Morgan take over, and AIG was technically bankrupt, but it wasn't allowed to fail. The CEO of the biggest insurance company did some creative accounting when he learned back in 2005 that these subprime mortgage assets that AIG had insured were so weak, and he tried to do some, as I say, creative accounting to make this look back. Then the governor of New York, forced him out of AIG, and being forced out of AIG, it meant that the ratings agencies then downgraded AIG because of this, and that required AIG to put up more, about $15 billion more for their extra cost accounting. Of course, later on, Spitzer had to resign for very different reasons, which you probably all heard about. But then the bailouts, $700 billion bailout, huge, much discussion of it. How is it going to be allocated? A great deal of anger at it, because when Paulson said $700 billion, we're going to bail out the banks, it just seemed to be a Wall Street man protecting Wall Street. and the Congress then started to impose different limits on it. And what the decision finally was that the half of that amount would be saved for the new administration to bail out. Then 800 billion credit line from the Federal Reserve to bolster the economy, another additional amount, but on the monetary side. And then Europe called for a new international monetary system. Now, the bullish signs in the U.S., in the housing market in the U.S. seem to be the case. The dollar has soared. Europe is in recession. But this is in the spring now, the U.S. is in recession too. And then Japan's economy was given a $15 billion stimulus. Let me just say this, that the stimulus of increases in spending is not necessarily a good plan for economies with flexible exchange rates. There's a model that has my name partly attached to it, the Mundell-Fleming model, that takes a world of perfect capital mobility and argues that if you have an economy like Japan increases spending, the effect of that will be to tighten credit. If there's no expansion of the money supply, it'll tighten credit, attract capital, worsen the trade surplus or increase the trade deficit, and eventually the increase in the trade deficit or worsening the trade surplus will exactly offset the increase in spending, and there'll be no effect on the economy. In fact, of course, that effect doesn't disappear, but if Japan spends 15 or 20 or 50 billion dollars, it'll give a stimulus to the rest of the world of $50 billion, because the multiplier is transferred abroad if capital is perfectly mobile. Anyway, that may be an extreme view of it, but it shows that the advantage of big spending plans is not really very good. Now, what are the errors or lessons from the crisis? Certainly the system of securitization and ensuring mortgage is grossly defective. Too much distance between the issuer and the owner. But remember, the good side of this innovation, that you could securitize things like this, assets. The bad side of it was that these bad assets allowed to get into the system. The good side of it is it opened up a whole new field of finance. It was a new, tremendous innovation that could be great benefit in the world in a different, say if it's properly controlled. Then the second problem is compulsive mark-to-market accounting requirement is a mistake. Now, why did suddenly the accounting people shift to the mark-to-market thing? They did it because of the past big failure, Enron. And Enron had done something grossly negligent in keeping assets on their books that had ceased to be really very valuable. They'd kept them for years. And this was this mark-to-market fetish or new plan revision was designed to correct that problem. But the problem is that every crisis is different. And that mark-to-market thing helped to create and accelerate, deepen this particular crisis, because it means sometimes a lot of assets go down on the books, but people expect them to come back up in 6 months' time, something like that. Just hold on and wait and not react to it. But when they do, when they mark these up as poor assets, then it immediately creates an increase in demand for liquidity because their capital is now deficient, and they have to add more to replace that liquidity, and that creates a major problem. Then the variable rate mortgages, I thought a terrible idea, but Alan Greenspan was the big sponsor of those, and I think that's proved to be a mistake, because you make you're doing fine. Then when interest rates rise, people can't pay them anymore. Then the bond rating companies, certainly it wasn't their big hour. They should have had a much higher stand here. And policy mistakes, of course, a big allowing Lehman to fail. This almost $1 trillion bank, it was just 150 years on Wall Street. It was just surprising, to say the least, that this was allowed to fail. I think that's almost everybody agrees in retrospect this was a big mistake. Now, the Federal Reserve certainly was too easy, too long. It created the housing bubble and the lack of surveillance over the financial system and neglect of exchange rate swings. The Federal Reserve errors, though, are closely tied to the present international monetary system. The system relies upon big swings in exchange rates. These are not necessary and they're harmful. The swings in the dollar-euro exchange rate is endemic to the system. Now, here's a kind of conundrum that I've suggested for 2008. Conundrum in the sense of a problem to be understood. In every recession, all the recent recessions in the United States, the low interest rates have been there, and they've always been coupled with a low dollar. But at the present time, which the Federal Reserve calls the recession, and I'm sure it is now if it wasn't before, we've had low interest rates now, but we've got a high dollar. You have that soaring dollar in the last 4 months that went from when the euro was one point close to $1.63 or 4, and suddenly the euro plummeted to $1.24. It's probably $1.27 today. So why are we having this period of strong dollar in the middle of a recession? It hasn't happened before. That's what is something to be right. And was that appreciation partly culpable in the failure of Lehman Brothers? I think it was, because whenever a currency is appreciated, this creates deflationary pressure in that country. So this is something to think of. So what you could argue is that had the Fed just started to support the euro when it was falling, maybe if it stopped it at 150 or 140, if they'd started to intervene and then added more liquidity to the economy, which the economy wanted. There's definitely a shortage of liquidity in the economy and very tight credit. Then you'd have got the liquidity you needed, and you wouldn't have had the weak period in the fall, and the U.S. economy would have gone on recovering. So that's at least a conjecture. In retrospect, we'll take a few more months to see if that's correct, but I believe that plays a part in it. Now, here's the dollar cycle, since we're talking about that. That starts in 1970 at the left side, and it ends in 2008. And you see this weak dollar. This is the euros per dollar. They went way down. Now, of course, before 1999, you didn't have a euro, but you had the ECU, the European currency, which stood in for it, a weighted average of the European currencies. Now, you have the falling dollar of the late 1970s, the soaring dollar under Reaganomics of the early first half of the 1980s. Then you have the the falling dollar after the Plaza Accord in 1985, and that brought the dollar way down low by, if you could look up there, ahead of 1992. 1992 was the ERM crisis. Remember, Italy devalued by 8%, and then that was a period when the Deutsche Mark was soaring to its all-time high against the dollar. The dollar fell to an all-time low against the Deutsche Mark in August 1992 of 1.34 Deutsche Marks. And so that was over this period. And then, now, in that first part, the first half of the 1980s and the part of the second half, you had this whole big tax revolution in the United States, where the top marginal tax rate got down from 70% at the federal level down to 28% when Ronald Reagan left office. When Reagan came into office, the tax rate was 70% at the federal level, and that goes up to 85% if you count state and local taxes in New York, which has a 15% state and local tax. So these huge stifling tax rates asphyxiating the American economy, suddenly dropped down in 2 steps to 28%. And then so the U.S. economy started to soar, and that's what stimulated the process by which you got the Silicon Valley IT revolution in the 1990s. And then the dollar soared again over this period because the U.S. growth rate was doubling. Well, it doubled in the last half of the 1990s, and it continued on. Then, of course, the NASDAQ burst, the bubble, the high-tech bubble burst, and NASDAQ collapsed, and you had the global slowdown for 9 months, of a contraction for 9 months, and then a continued slowdown for several more months after that. And then you have, over this period, the dollar going way, way down. And last year, everybody was saying, do we have to replace the dollar? Is the dollar on the last legs? Every 6 months ago, currencies all over the world were saying, what are we going to do with the dollar? Should we get off the dollar? Should we go on to the euro? Should we do something else with it? Should we appreciate? Should we float? Countries that were tied to the dollar. All the Gulf currencies have their currencies, except Kuwait, fixed to the dollar. And then you had capital movements coming in, inflation pressure, big housing booms in those countries, and everything going on. And they were all talking about, should we appreciate against the dollar and then or float and let it float upwards. And that was true with China. It was true with Hong Kong and all the ASEAN countries in Southeast Asia. We're all thinking about appreciating. But then 6 months later, suddenly, everything turned around. Even 4 months later, it turned around, and they were all, first of all glad that they hadn't changed their policy, because then the dollar became tight, and now those countries have been drawing on the swaps from the Federal Reserve. So there's a complete turnaround with that tightness that came into the Fed system. Why did the Fed become so tight? Now, not by looking at interest rates, but by looking at the exchange rate. These are two measures of tightness they're in. And, of course, you could say, if you wanted to have a conspiracy theory, you could say, well, Bernanke was an Obama fan. And a way to get Obama elected was to keep the dollar tight and create that recession. I don't believe that was the case. I don't believe that's the case, but it's plausible because he did openly support Obama toward the end. But I think it's I think that's because the Fed makes the same mistake that I think the Bundesbank used to make, that they ignored the exchange rate in their formation of economic policy. And they didn't think of it as being tight because they were looking just at interest rates. You know, the famous Taylor rule for Fed policy just uses interest rates in relation to unemployment or inflation, and they don't have anything about exchange rates in it. So anyway, now these are the cycles. You've seen that on the graph, so I don't need to go into that. Harmful effects of swings in exchange rates. You know, the euro is a wonderful currency now. It's a measure of assets in the economy. But can you imagine the huge swings in the euro that have taken place since the euro came into being? The euro came into being at $1.18. Then it slumped to 82 cents, the low point. Then it went back up in the next 3 years to $1.37. Then down to $1.15. And then the next episode was to go up to $1.64, and then within a few months go down to, I think the low point it reached was probably $1.24. Those swings in exchange rates are just completely unsettling. For financial assets, you can say, if money is just the euro, is just a financial asset like any other financial asset. That's what finance people think of it as. They don't think of it as a measure of value. And that's what money is, a measure of value. The unit of account value of money is the most important value of money. The important function of money is, John Maynard Keynes was clear to say. Well, most of the why I'm building up to this is that most of the great banking crises in history are rooted in either deflation or currency instability. This was true of the liquidity crisis of the 1930s, when Europe went back onto the gold standard, and the rest of the world followed and created a big excess demand for gold and raised the value of gold by that deflation. Every big economy in the world suffered, with the exception of Britain, who got out of the gold standard in 1931, suffered a 35% deflation in 3 years from 1930 to 32. Everyone. This was caused by deflation. American banks, 2,000 American banks crashed over that period. Of course, these are typically small banks. So in the 1930s, but it was through there. Now, I've mentioned this. The return created a scramble for gold in that depression. Then the second, the next thing to note is that there were no banking crises, big banking crises in all the period of the Federal Reserve System in the post-war period, when the world had a system of fixed exchange rates. But after the floating rate system with the big swings in exchange rates, there's the Savings and Loan Corporation, which came about because of the big swing between short and long-term rates. And then there is the international debt crisis, which came about in 1982. And then the Asian crisis. And this is also caused by currency instability. You can read it there, but you can read these. You can look at these things after, so you can read it. But now, what determines the timing then of the crisis in August 2008? Probably the appreciation of the dollar when the euro fell from $1.60 to $1.25. The dollar appreciation overvalued those weak assets of Lehman even more than they were already. The arrangements made until now. Bretton Woods was what people have said we should go back to. It was a system in which the dollar supplies were kept in check by the discipline of U.S. gold convertibility. Other currencies were kept in check by their international reserves. The Bretton Woods system, so to speak, was an unusual system because it was asymmetric. The dollar was in a special position. And it was in a special position because of the size of the U.S. economy in that period. The size was so great that you could not have a system in which the United States economy was put on the same foot as the other economies. The role of the dollar was too important in that. And so the U.S. fixed the price of gold and the other countries fixed to the dollar. Now it's changed, and we've got back to a floating system, and the dollar is in the U.S. economy is not quite so dominant as it was at that time. And you've got now a change in the power configuration of the system because you've got the euro creation, which is a big thing now. Yeah, but the system is not working well today. Look at this. Look at what China's done in this system. China, since 2002, has added to its reserves over $200 or $250 billion every year. They've now built up, they had $200 billion of reserves in 2002. Now they've got, by the end of this year, they'll have $2 trillion of reserves. And they couldn't, under a real system, international monetary system, they couldn't add to their reserves by that amount without taking it away from other countries. Under the gold standard, it would have crashed the system. They couldn't have got it. There would have been deflation that arises from that policy. But now you've got, China gets more reserves and the U.S. creates more dollars. And China can keep on doing that as long as they want to hold the dollars. So these are currency areas in the system. It's important to look at that because it shows the size configuration of the countries in the system, how important in the system is the big economies, especially the dollar economy and the euro economy, the big three, the big two. And then they're more or less proportionate to GDP, but the GDP of the U.S. economy is $14.5 trillion. The GDP of the euro economy is, at current exchange rates, probably about $11.5 trillion. The GDP of the yen economy in the upper left is $5 trillion. And the GDP of the number 4 economy in the world is the Chinese economy, is $4 trillion. And the GDP of the British economy, the number 5 economy, is about $2.5 2.5 trillion. So what happens to the international monetary system depends very much on what happens between the big two or the big three countries. And it was a possibility of an Asian currency area. That's been widely talked about. It's had some setbacks. It's not going to be an Asian currency area like the euro area, because there's no possibility in the near future of Japan and China tossing in their national currencies for an Asian currency, because there's not the degree of political harmony between those two countries to make that possible. Just as you couldn't have had the Eurozone until a certain amount of harmony had developed between the France and Germany, for example. And that was a necessary condition for this. But that's a possibility. Another possibility would be the APEC, that's the Association of Pacific Economies, which would be centered around the dollar. And the dollar, you could have an East Asian dollar standard that would include very easily China and Japan. And if you had that, you'd have 3 very large economies in the world. The only big economy outside it would be the euro economy. But then you could then find a way that Europe could enter that, and you could do it. Now, I want to talk just to close, getting toward the end here. 5 problems in the system right now. What we should do now: confidence problem. There's certainly a great lack of confidence. There's a credit crisis. There may be easy money at the part of the central banks, but there's tight credit in all the banks. The banks don't want to lend. They're afraid to lend. And that's restoring confidence is very important. Then the problem of recapitalizing the banks and corporations. Then you need some increase in effective demand in the economy, and you need an increase in investment and effective supply. And then a restoration of the international monetary system. So those are the 5 problems, and we have to have five policies to deal with them. So these are my candidates for it. For confidence, you need a good management team. Obama has made a good start, I think, on his team. People in the United States and the rest of the world want him to succeed. You could say he's the first president elected by the world, because the world seemed to support Obama rather than McCain. And then now, so that team is good, but you need something else. You need an international side to that team. Europe should have a team. The Euro area should have a team like the Obama team on the inside. Obama has he's got Paul Volcker as the head of the White House team, with the responsibility of overseeing the restoration of confidence and equilibrium after this crisis. And it would be a very good idea if Britain and the Eurozone and Japan would add theirs and make that an international team, so that would work. So that would be the first thing I would do with that international team, and I would tentatively think having Paul Volcker chair that team would be a very good idea. Now, the recapitalization of banks, and this is also to encourage increased investment. At present, in the United States, the corporate income tax is 35%. It means that the United States takes out 35% of all the profits of corporations without putting anything in. They've got they've got an ownership share of 35% in all American corporations, including the banks, without contributing any capital to the banks. And more than that, they get 35% of the profits, but they don't have to share in any of the losses. So it's a punitive thing. So I don't think it's a silly idea to take $250 billion of this $700 billion and go and buy bank assets in order to recapitalize the banks. All you need to do instead is to cut the corporate profits tax and get the government off the back of those corporations. So I would like to see that tax. Look what Germany did last year. Germany lowered its tax rate on corporations from 38.7% it was 2 years ago, it was 38.7%, and they planned to lower it to 29%, but in fact lowered it to 15%. This is a wonderful thing, and I think the United States should do exactly the same thing, and every country in Europe should get their tax rates down to 15%, except Ireland, because Ireland's corporate tax rate is 12% or 11.5%. They wouldn't have to raise it, but that would be a wonderful thing, because you remember the corporate tax is a double taxation anyway, because you tax the corporation and then you tax it at the individual level. You tax, first of all, the profits of the corporation, some share of that, and then what's left that go out as dividends, you tax those at the individual tax rate. So the loss of revenue would not be that great. All right, then to increase effective demand, I'd issue $1,000 worth of dated vouchers, a little bit like food stamps that is used in the United States for the poor, but make them generalizable into any manufacturing area, and dated, so they have to be spent within 3 months or 2 months. And they are used for purchases from any retail enterprise that pays taxes. And then the retailer can use them as vouchers for taxes already paid. So it would be a very simple thing to administer, and it would suddenly increase. If you did $1,000 for every person, it would be a $300 billion increase in effective demand that would come very quickly and would do a lot to jumpstart the recovery. And then, as I say, this was tied in with the recapitalization of the banks, the permanently lower corporation taxes to 15%. This tax on corporations is a very inefficient tax anyway, because it's a tax on an institution. It dissuades people from forming that institution, which is the most efficient form of institutions. Now, the United States has divided its corporations into there's S corporations and C corporations. S corporations, if you apply as an S corporation, an individual shareholder is taxed on the whole profits of the corporation, but at the individual tax rate, and there's no corporate tax. So that escapes the income tax. The only trouble is that you can only become an S corporation if you have fewer than 75 shareholders. So this means that you can't do it for the big corporations, and that's what the most efficient form. The corporate tax, just mentioned this, my colleague, Nobel Prize winner in 1997, he's famous, tragically in a way, because the Nobel Prize was announced on about October 13th, and 2 days later he passed away. He was going up to give a speech in Boston, and he died. But he was a liberal, a very strong liberal, but just as an indication of this isn't a left-right issue. He regarded the corporate tax rate, corporate profits tax, as an abomination. It was a terrible tax because it offends against all the efficient rules of the economy. Then the fifth thing is to, because of the big swings in the exchange rates, to restore the international monetary system, rebuild that based on fixed rates. Now, there are two levers I would use. I don't believe in making a blueprint for an international system. You have to make the system, show that the system can evolve naturally. Right now, you've got China's gone back to more or less a fixed exchange rate with the dollar, around 6.8 yuan to the dollar, after getting it down from 8.28 over a 3-year period. Now, keep that and let the RMB and U.S. dollar be the platform for an Asian currency area. And then the other platform, the other direction would be to move toward stability in the dollar-euro rate, but starting with a band between them, because it's ridiculous to have 80% up and 80% down in the exchange rates. And the rates now, the euro started off at a rate of $1.18, not a bad rate for it. And now, but what I would do now, in view of the history of the dollar in recent years, I'd put a floor to the euro at $1.20, something like that, and a ceiling to the euro at $1.40. and let that, and you could manage this very easily and very efficiently, in unbreakable way. Speculators couldn't attack it if you do it in this way. You do it so that the U.S. supports the euro when the euro gets down to $1.20, and they can buy as many euros as they want because they pay for them with newly created dollars. And then if the euro rises to $1.40, then that's when the European Central Bank would support the dollar, and they do that by selling euros and buying up dollars at that rate. So they can do that in an unlimited amount. I think for a long time now, the euro-dollar exchange rate would stay between $1.20 and $1.40. But you could always move the limits if you thought that it was needed some big adjustment. Well, now let's talk about something about what to do, what the implications are for markets. I think the first thing is that what is the likely plan, what is the likely course, policies that would be followed by Obama, certainly is a major issue, and by Europe. So if Obama accepted this idea of cutting the corporate profit tax, the Dow Jones average would shoot up very quickly, and it would that would be a no-brainer as to what you would want to buy if you believed that he was going to do that. Now stocks are the Dow Jones average is about 8,000 around that now. They're great buys. They're a great time to pile up a whole amount, and great buys under any circumstances, but especially if you thought that he was going to do something like go along with what Germany did on the corporate tax rate. This was because what happens is that if you suddenly make after-tax profits, all expected profits become much higher after-tax profits, and that will automatically shoot up the stock market. But you have to then forecast what is the probability that he's going to do that. He's got a problem in cutting a big corporate profits tax because in the United States it's looked upon as a boondoggle for the wealthy. They think they're taking away they're taking profits away from oil companies and things like that, and it might be hard to do that. To maybe they could do it. When I was in the United States earlier, I suggested since not many companies are going to make profits next year if the recession is high, have a 1-year tax holiday and then come back with a corporate tax holiday, no taxes for 1 year, the recession year, and then put a 20% tax rate on the year after that. Maybe 20% would be something more appropriate. But he's going to have to do something. I think was it Carlo who was saying you need to do something strong to the economy. You've got to do something substantive that's going to change the new equilibrium of the economy too. You can't just go up and say you've got a nice team of Clintonites people that were there before, but they have to do something that's going to be, and just spending is not going to do it. It's not going to be enough to do the economy. So the tax rates would be a good thing, and I would not rule it out that action could be done on the corporate tax rate. Stocks in that case would be a no-brainer as the best thing to buy. Right now, the European Central Bank is going to lower interest rates more, and it may be then that for a short time the bonds are not a bad investment but I think in the short run they're a good investment if there's expectation that interest rates will be lowered. Bond prices would go up, but then later they're not going to. Then you'd have to sell them again because the interest rates are too low in the long run for a long position in bonds. So I wouldn't want to gamble very much on that. Everything here now in the world, especially with flexible exchange rates, where you don't get a smooth adjustment around the world of prices, has a geographical location. And the question is, in real estate, my own view is that that 6 months ago was that the European real estate market was reaching a peak and was going to go down. But now that the euro has gone down, these are substitutes. These are asset prices. You can either have the euro go down, and that makes a better equilibrium of European prices, or you can have the asset prices go down. So the fall in the euro may have avoided the falls in asset prices, and because of that, then I don't expect that fall in prices. So I think real estate at the low euro is not such an investment that you want to shun. I'm not saying the European assets are better. Real estate is better buys than it was 6 months ago. China is in real estate. There's a difference between commercial real estate and housing. Commercial real estate is still going through a boom. It's still expanding, maybe 20%, something like that. I think that's going to slow down very much as the Chinese import some recession. So it's not going to go up too much. And you have big companies like Blackstone that have formed real estate big trusts and bought heavily into Chinese real estate, and they're now asking for concessions because a lot of those assets have gone down in price. And there's a big overhang of real estate assets in China and the retail of the housing levels, apartments and villas and so on. There's one place I know, a big developer in Guangzhou who has 1,500 high-level real estate type apartments worth $1 million each, and he's just taken those off, a lot of those off the market. He's not selling them now because it's just so what you're getting is you're not getting the downward adjustment so much just because those retails have kept, but there's a big overhang of housing prices. So I don't think we would go into that too much. And you remember also you have to look at the different cities have different. You have to look particularly at Guangzhou and Shanghai and Shanghai real estate market has been very poor. Beijing market is down, but is not so much. It's down somewhat, but remember, Beijing is always going to have, because it's the capital, is always going to be not so much a bubble city. Shanghai is much more of a bubble city, and then other places like Nanjing and Guangzhou are going to be good places. Overall, Chinese real estate is still very low compared to big capital real estate, big capitals. I think there's probably a doubling in general of real estate over the next 5 years. That's got to have doubling or tripling because they're very much below the equilibrium level. Thank you.